Welcome to this deep dive. Today we are taking a close look, a real specialized trip into the world of commercial real estate. We're dissecting the recent Q3 2025 earnings presentation and the press release for CBRE Group, Inc. Now, the sources, they're pretty dense, lots of financial terms, market specifics. But our mission today is clear. We want to quickly pull out the core story, pinpoint the operational drivers behind their current success, and really gauge the financial health of the business. We're trying to cut through the numbers to get to the strategic narrative.
Exactly. And, if you're looking for the main takeaway, the absolute top line, the message from CBRE is that they produced, and this is their phrase, excellent results. They really beat expectations. And they put that down to, well, the power of their scale and having a really diverse mix of businesses. But I think what's most important for you listening is the context. The new guidance they put out, it feels like a major inflection point.
Okay, inflection point, that's a strong term. Let's see the numbers backing that up. We saw some pretty impressive year-over-year jumps. GAAP EPS, that was up 56% to $1.21, and the Core EPS, which gives a cleaner operational view, that was up 34% to $1.61. When you see growth speeding up like that, especially given some sector headwinds, it suggests something fundamental might be shifting in their strategy.
Precisely. Let's start with those big quarterly numbers. Q3 2025 versus Q3 2024. Total revenue, it grew 14% to $10.3 billion. Now, for a global company like this, we often look at local currency to filter out, FX noise. And on that basis, revenue was still up a strong 11.8%.
And profitability grew even faster. That suggests they're getting more efficient.
It did, yeah. Core EBITDA, a good proxy for operational cash flow that increased 19% to $821 million, which means basically for every dollar of revenue coming in, they kept more as profit compared to last year. That kind of acceleration is exactly why they felt comfortable raising their outlook.
Right, which brings us to that raised full-year Core EPS guidance. The new range is $6.25 to $6.35. That's up from $6.20 to $6.20 previously. That move feels pretty significant, not just in dollar terms, but maybe symbolically too.
Oh, definitely. The sources really hammer home the importance of this. The midpoint of that new range, $6.30, isn't just 24% growth year over year. It's projected to be more than 10% ahead of their prior peak earnings. Just let that sink in for a moment.
Wow, ahead of the prior peak already. The timing on that is interesting.
It really is, because, comfortably beating their old record is happening just 2 years after the commercial real estate market really hit bottom. It's kind of the ultimate proof for their strategy, right? They built this diversified, resilient company that isn't just riding the wave of a good CRE cycle.
Yeah, the distinction they make, resilient versus transactional, seems absolutely key to their story. So let's break down where that $10.3 billion in revenue actually came from, using those two buckets.
Okay, so think of the resilient businesses as the sort of reliable engine. This is stuff like facilities management, loan servicing, steady property management fees, predictable stuff. These made up the bulk of revenue, up 14% year over year to $8.4 billion. These are the streams that provide that stability, that defense, when the market gets choppy.
Okay, makes sense. And then the more cyclical part, the transactional businesses.
Yeah.
Property sales, leasing, development fees. It sounds like that side didn't actually lag. Revenue there was up almost the same, 13% to $1.9 billion.
Pretty much neck and neck, yeah. It looks like they managed to catch the upside of some transactional recovery while still leaning on that resilient base. And that balance, plus some smart internal management, leads to what analysts really like to see: operational leverage. The presentation specifically mentions cost efficiencies driving this leverage, profit growing faster than revenue.
Right, operational leverage. It's powerful, but sometimes it feels a bit abstract. Can you maybe make it more concrete? Show us how it looks in their actual segment data.
Sure, we can see it pretty clearly in a big chunk of their stable business, the Building Operations and Experience segment, or BOE as they call it. In BOE, the segment operating profit, the SOP, it grew 14.8% in local currency. But the revenue for that same segment only grew 10.7% in local currency.
Wait, so profit growth beat revenue growth by, what, over 4 percentage points?
Exactly, that gap. That is operational leverage in action. It basically means the company's getting smarter, more efficient in delivering its services. The cost to earn and manage that next dollar of revenue is significantly less than the first dollar. They're using their scale to lower delivery costs, and that drops straight to the bottom line.
Okay, that efficiency story is great. But the real, maybe, intrigue is in the market details. Let's dig into the individual segments. Starting with advisory services revenue, there was up a solid 16.8% in local currency. Where did the acceleration come from on the leasing side of things?
Global leasing was definitely stronger than maybe some expected, up 17% local currency. Geographically, a couple of standouts. Asia Pacific, APAC, was really the star performer, grew 23% in local currency. And they specifically called out India and Japan as leading that charge.
India and Japan. Why those two specifically? Is it broad economic lift or specific types of properties driving that?
Well, the sources suggest it's a mix, but leaning heavily towards specialized demand and just regional economic growth. We know the U.S. leasing market was also strong, up 18%. But the drivers there are really interesting, led by data centers, industrial, and surprisingly, office properties.
Hold on. Office. Really. Given everything we hear about stress in U.S. office markets, that feels like an outlier. Do the sources explain what kind of office demand is driving that? Is it a specific niche?
It seems to be, yeah. Specialization and premium assets. The suggestion is that the top-tier specialized office space, highly amenitized, prime locations, it's still drawing tenants and capital. It's kind of a counter trend to the broader distress you see in older, maybe lower quality office buildings. But the biggest theme, really across the board, the non-cyclical driver, seems to be that infrastructure demand.
And we see that same theme popping up in capital markets, which is property sales, right?
Absolutely. This is where the acceleration was, frankly, dramatic. Global property sales revenue jumped a huge 28% in local currency. And again, APAC was just on fire, up 50% in local currency. Japan, again, specifically highlighted for incredible activity. U.S. sales revenue also very strong, up 32%. And the report confirmed it was led by those highly specialized assets, data centers, and yes, office again. Industrial and multifamily also showed strong double-digit growth. Really confirms that if you own or manage the right kind of specialized asset, you're playing in a totally different sandbox than the rest of the CRE sector.
Okay, that consistent mention of data centers across both leasing and sales is definitely something to note. Now, shifting to that core operational side, building operations and experience, BOE. Revenue up 10.7% local currency.
Right. Growth there was fueled by sort of two main things. First, strong local market share gains, especially in the Americas and the UK. And second, crucially, a massive amount of work on the enterprise side. That growth was really paced by large contracts for data center hyperscalers and also new client wins in tech, healthcare, and industrial sectors, too.
And property management within BOE saw that huge surge, up 29% local currency. What was behind that specific jump?
Yeah, that big jump is mostly down to a specific strategic move. It reflects the contribution from Industrious, that flexible workplace operator they bought back in early January 2025. So it shows they're integrating these newer, high-growth models into their main service offering.
Got it. Let's follow that infrastructure thread again over to project management. Revenue there was up 18.5% local currency. Was it the same kind of specialized clients driving demand?
It was, yeah. Project management saw broad-based double-digit growth pretty much everywhere, UK, Middle East, North America, and the client demand, primarily driven by large construction and infrastructure projects for, guess who? Those same data center hyperscalers, and also, separately, a big infrastructure project for the UK government. But yeah, that hyperscaler theme just keeps weaving through almost every major segment.
Okay, finally, let's quickly touch on real estate investments, REI. On the surface, revenue looked down, right? Fell 32.1% local currency.
Yeah, that drop looks a bit alarming at first glance, but it's mostly noise, really. The decline was largely because they had some unusually large incentive fees hit in last year's Q3. It makes the year-over-year comparison look skewed. The actual underlying development business, though, showed really significant operational improvement. Global real estate development actually flipped from a small operating loss in Q3 last year to a $35 million operating profit this quarter. That was driven by selling some assets in the U.S. And importantly, their assets under management, AUM, keeps ticking up slowly, now at $155.8 billion.
Okay, so moving past the operations, the balance sheet seems to back up the company's claim of having, meaningful optionality, which is basically analysts speak for financial strength and flexibility, right? How's the cash generation looking?
Exceptionally strong. Free cash flow for just Q3 was $779 million. That's up 58% from Q3 last year. And if you look at the last 12 months, trailing 12 months, free cash flow is nearly $1.5 billion. When you're generating that kind of cash, you maintain a lot of liquidity. Their total liquidity is now $5.2 billion. That's up almost $500 million just from the previous quarter.
And that cash cushion translates into a very conservative debt position, I imagine. Gives them breathing room if markets wobble.
Absolutely. Their net leverage ratio is really low, just 1.23 times. Compare that to their main debt covenant, which allows them to go up to 4.25 times. They are nowhere near any kind of stress point. And the sources confirm they plan to continue paying down debt through year-end, just giving themselves maximum flexibility for whatever comes next, investments or buybacks.
Speaking of buybacks, they have been returning capital. The company bought back about 5.2 million shares for roughly $663 million since the end of 2024. That signals some confidence in their own stock price.
Yeah, it definitely does.
Okay, so to sort of wrap up this whole deep dive, the key operational finding seems to be that the combination, that synergy between the steady, resilient businesses and those accelerating transactional ones has been incredibly powerful. That, plus the operational leverage and efficiency gains, let them hit that new record core EPS outlook.
And that success, it really all comes back to that central theme of scale, their sheer breadth and depth across every asset type, client type, business line, geography. That scale is just crucial because it lets them find and really capitalize on those specific niche areas, those secularly favored spots that seem almost immune to the broader cyclical ups and downs.
Right, that idea of secularly favored feels like the real takeaway here. We heard that constant repeated mention of data centers and hyperscalers, waving through the story of literally every major segment: leasing, capital markets, BOE, project management. It really suggests that the huge nonstop infrastructure demand from AI and cloud computing isn't just a trend anymore. It might actually be the single biggest, maybe non-cyclical force shaping the global commercial real estate market right now. So the question maybe for you, the listener, to think about is this: how long can this highly specialized, massive infrastructure demand keep propping things up, offsetting the volatility we see elsewhere in traditional commercial real estate? And what strategic shifts might be needed if, or maybe when, that hyperscale demand eventually starts to level off? Thanks for joining us for this deep dive into the sources. We'll catch you next time.